Most people believe you can only make money when stock prices go up. But what if I told you that some traders make money when prices go down? This strategy is called shorting stocks. However, this is not a get-rich-quick method. It is not for gamblers, and it definitely comes with risks. In this video, I will explain shorting stocks from zero level, in simple English, with real examples, and most importantly, I will clearly explain the risks so beginners don't make dangerous mistakes. Watch till the end, because understanding the risk is more important than understanding the profit. Part 1. What does shorting a stock mean? Let's start very simple. Normally, when you buy a stock, you buy low, you sell high, you profit from the price going up. Shorting is the opposite. In shorting, you sell first, you buy later, you profit if the price goes down. So the idea is simple. You make money when a stock falls. Part 2. Simple real-life example. Imagine this situation. A company's stock is trading at $100. After research, you believe this company is overvalued and the price will fall soon. Step 1. Your broker lends you one share of the stock. Step 2. You immediately sell it at $100. Step 3. A few days later, the stock drops to $70. Step 4. You buy the same stock back at $70 and return it to the broker. Result: sold at $100, bought at $70, gross profit $30 before fees. That is how short selling works. Part 3. Why shorting is more dangerous than buying. This is extremely important for beginners. When you buy a stock, maximum loss equals what you invested. If you bought at $100, worst case it goes to $0. But when you short a stock, loss can be unlimited. Why? Because a stock can go from $100 to $200 to $100 to $500 or even higher. That's why shorting is considered an advanced trading strategy. Part 4. Why do people short stocks? People short stocks for different reasons. 1. Overvalued companies when price is much higher than real value. 2. Bad news or weak fundamentals, poor earnings, high debt, bad management. 3. Market crashes or downturns. During bear markets, shorting becomes common. For hedging, some investors short stocks to protect other investments. Shorting is not guessing. It is analysis-based. Part 5. How beginners can approach shorting safely. Beginners should not jump directly into aggressive short selling. Here are safer approaches. Option 1. Learn before trading. Study basic technical analysis. Understand support and resistance. Learn risk management. Option 2. Use small position sizes. Never risk a big part of your capital. Option 3. Always use stop loss. A stop loss limits damage when price moves against you. Part 6. Shorting versus put options. Beginner comparison. Many beginners choose put options instead of direct shorting. Direct shorting: unlimited risk, margin account required. Put options: limited risk, maximum loss is known, more beginner-friendly if learned properly. However, options also require learning. Never trade what you don't understand. Part 7. Common beginner mistakes. Avoid these mistakes at all costs. Shorting hype stocks, ignoring stop loss, risking too much capital, trading based on emotions. Following social media tips, blindly shorting without discipline is one of the fastest ways to lose money. Part 8. Is shorting stocks right for you? Ask yourself honestly, can I handle losses emotionally? Am I willing to learn deeply? Do I understand risk management? If the answer is no, focus on learning first. There is no shame in staying out until you are ready. Part 9. Educational warning. Very important. This video is for educational purposes only. Shorting stocks involves real financial risk. Many professional traders lose money doing this. Never trade with money you cannot afford to lose. Ending. Final thoughts. Shorting stocks is not evil. It is not cheating, and it is not gambling when done correctly. But for beginners, knowledge matters more than profit. Learn first, practice with paper trading. Respect risk. If you want a full beginner trading roadmap, a paper trading tutorial, or a safe introduction to options, comment stocks below. Like the video, subscribe for more honest trading education, and remember, In trading, survival comes before profit.
Hello friends, welcome back to my channel. So friend, most people believe you can only make money when stock price go up. But what if I told you that some trades make money when prices go down? Okay, this strategy is called shorting stocks. However, this is not a get rich quick method. It is not for gamblers and it is definitely comes with risks. In this video, I will explain shorting stocks from zero level in simple English with real examples. And most importantly, I will clearly explain the risks, dangerous mistakes, watch till the end because understanding the risk is more important than understanding the profit. Part 1. What does shorting a stock mean? Let's start very simple. Normally, when you buy a stock, you buy low, you sell high, you profit from the prices going up. Shorting is the opposite. In shorting, you sell first, you buy later, you profit if the prices goes down. So this idea is simple. You make money when a stock falls. Part 2. Simple real life examples. Imagine this situation. A company, a stock is a trading $100. After the research, you believe this company is overvalued and the price will fall soon. Okay, so friend, this is my video. So please like my video and subscribe my channel. Thank you so much.